In this presentation, we will enter adjusting entries into our practice problem in QuickBooks Pro, QuickBooks Desktop. Here we are in our QuickBooks practice file. We currently have the open windows open. You can open the open windows by going to the view dropdown and selecting the open windows list. Now let's take a look at our Excel worksheet to see what our objectives will be. We're going to be on number 7 here. So we're going to say that number 7, let's first take a look at that. Volunteer time contributed to the general activities estimated at $15,900. Now, we have to put this in place because this is going to be a common type of question. What if someone does volunteer work for the charitable type of organization? If it's non-professional type of work, meaning, kind of work that basically anybody can do, if it's going to be work that's not going to be professional in nature, then typically we're not going to have any journal entry for it. So even though, of course, the donated time is valuable, we're not going to be recording the donated time here for that. Now, if it's professional time that you would typically need to pay professional fees for, such as the accounting services or such as legal services or something like that, that would be a different story in terms of the donated time. However, if you're talking about general type of stuff, service time, then that's not going to be something that's going to have a journal entry for. So now, next thing we're going to have then, number 8 then says, amount of pledges estimated to be uncollectible is going to be the $21,600. Now, this is going to be similar as for a for-profit type of organization. What we're going to do is we're going to go up to the pledges, what we're thinking about up top, and we won't get into basically how you are going to estimate this estimate. This is basically an accrual type estimate, same kind of idea that you would have in a for-profit type of organization. We do have a course on receivables and estimating uncollectible amounts on the receivable if you want to check that out. But note that we have the receivables here. Now we're going to say that some of these receivables are not going to be collectible. Now remember what happened here is we basically got pledges and we've given nothing in return, really. It's just a promise to pay us because we're a charitable organization, unlike a for-profit where we did work and then they have a receivable on the work where we might have some more recourse possibly. If it's a pledge, we may not have a whole lot of recourse depending on the type of organization that we have. Then we may have a high amount of receivables that are uncollected, and we should be reporting that on the financial statements so that we're not overstating the assets on the financial statements. Therefore, we need to make some type of estimate of these receivables we think are uncollectible and reduce them. Now, we cannot reduce simply the receivables account itself because we don't know which receivables are uncollectible. We're just going to make an estimate based on past information in order to think about how much of the receivables are uncollectible, and therefore we're going to create another account called allowance for doubtful accounts, or in this case allowance for uncollectible pledges, we'll call it here, and that's going to be the reduction of the receivable, kind of similar to a contra asset account, or it is a contra asset account similar to accumulated depreciation, or in this case the allowance for depreciation. The other side, note that revenue is overstated for the period, because we recorded revenue for a receivable for a pledge which we haven't received and we don't think we're going to get the money. Therefore, you would think we would either reduce the revenue, or in this case we're going to record an expense which is going to be called provision for uncollectible receivables. That's going to be the equivalent of kind of bad debt in a for-profit type of organization. Now we're going to have to shorten some of these names because QuickBooks won't allow us to have these really long names in the QuickBooks system, so we'll abbreviate some of these items. So therefore, we're going to record the expense kind of account, which is going to be the provision for the uncollectible receivables at the 21.6, and then the other side going into the allowance, which is going to be reducing the net asset type of account with a contra asset. Let's see what that'll look like. We're going to go to the provision and expense type of account. It's going to be going up by that 21.6 like so. The other side then go into the allowance for uncollectible. So we're going to go back up top, or we're calling it, the allowance for uncollectible pledges right underneath the receivable account. And that's going to go up in the credit direction, contra asset account. It's going to go up in the credit direction. So then if we net these two out, then we get to the 195,500 here. So if we net those two out, 195,500, that's what we're going to say the true or our best guess value is of the receivable asset on the books. And on this side, we're going to say, hey, look, this is the amount of the revenue that we think is overstated because we don't think we're actually going to collect on that, and we want to report it in this time period in accordance with an accrual type of principle. So let's record that, or think about how we would record that in QuickBooks. Now, if we go to QuickBooks, this is an adjusting entry. So typically we would use journal entries for this kind of end of period type of adjustment. So I'm actually going to use the journal entry function. We're going to go up top to the company tab. We're going to go down to make journal entries. We're going to make it as of the end of the time period. So I'm going to say OK, which is going to be 12/31/20. And we're going to say that the account that we're going to do the exact transaction here. Let's take a look at that transaction. We got the provision for uncollectible pledges. Let's actually copy that and see if it's too long to put into QuickBooks. So we're gonna say provision for uncollectible pledges. I'm gonna make a new account and tab and set that up. It's gonna be an expense type of account. Continue. And provision for uncollectible pledges. So provision for uncollectible. I'll just call it provision for uncollectible. And then we're going to say that we can put the whole thing down here in the description, and I'll save that. And that's going to be for the amounts of 21/6. So we'll say that's for 21/6. So 21/6. And the class, we're going to put it into the class of the fundraising. And then the second side of it is going to be going to the allowance. So the allowance account up here, so we're going to have to abbreviate that for sure. I'm going to copy this, and we're going to put that into QuickBooks. Allowance, we're going to set that up tab to set it up. New account. This one is going to be an other current assets type of account. You may even want to put it into a receivable, but if you do, you'll have to assign a name. The only reason you'd want to do that is to butt it up right next to the receivable account. And then I'm going to say that this is going to be this, and it says allowance for uncollectible, so I'll keep it just at that. I'll put the full name down here, and we'll say save and close, and there we have that. I'm going to put it into fundraising as the class as well. Save and close, and OK or yes. Let's then check it out. We're going to go to the reports up top. We're going to go down to the accounting and taxes. Take a look at the trial balance. Within the trial balance, we'll change the dates up top from 01/01/20 to 12/31/20, January through December. We can see that we have our allowance account. So allowance for uncollectible at the 21/6. The other side going into our provision for uncollectible 21/6. Now we have another similar type of transaction, typical kind of adjusting entry we'll also do at the end of the month. And that's going to be for the depreciation. So we're going to do the depreciation. Not going to get into the calculation of depreciation. We do have a course on that if you want to look into it. The general idea here being that we have the equipment and furniture. It's going to go down in value over time. We're going to allocate the cost of that furniture and equipment to the proper expense account, depreciation expense, in accordance when it's going to be consumed in order to generate revenue. That's going to be the matching principle. We're going to do that not by crediting the equipment account itself, and that'll help us to indicate to our reader, hey, this is just an estimate, as a similar case as this is just an estimate up top, meaning this is what we purchased the furniture and equipment for. This is going to be the amount that we're estimated it has gone down in value for. The difference between the two then is going to be the book value. So we're going to debit then an expense down below, depreciation expense. So if I record that out, it's going to be depreciation expense is going to be the debit. That's basically the consumption of the depreciable assets, property, plant, and equipment, like the furniture we bought. And then in the allowance account, we're going to be increasing in the credit direction, contra asset account. Funny that we're going to be increasing in the credit direction with an asset. And that'll do a similar process and tell us that, hey, this is the cost, this is the accumulated depreciation, the difference between the two, the 20,100 is the book value. All right, so let's go ahead and do that here in our system. We're going to do an adjusting entry for it as well. Going back to QuickBooks, we're going to go to the company dropdown. We're going to go to make journal entry. And then I'll close out of this, and we're going to say that this is going to be the depreciation And let's go ahead and copy it so I don't misspell it. Oh, I could have misspelled it over here, right? I could have, but I'm going to copy this and we're going to put it back over here. Depreciation expense, not on the bottom. I want to have it on the top. I'm going to put depreciation expense and we'll set it up. It's going to be an expense type of account and continue. Expense type of account looks good. And we want it to be 4,400, 4400. Class is going to be the fundraising. Then the other side is going to go to the, and they call it something slightly different, allowance for depreciation, which is like accumulated depreciation. So we'll put it into allowance for depreciation. And that's going to be a fixed asset type of account. And that looks good. Credit for 4,400. And once again, into the fundraising. Then I'm going to say save and close. And yes. And okay. Let's check this out then. If we go back here, we're gonna say that we have the depreciation expense. If we go down to the depreciation expense, which is here, and then the accumulated depreciation, which will be up top next to the furniture and fixture. There it is. Let's take a look at our financials. If we go to the reports drop down, company and financial, take a look at the balance sheet standard, changing the date up top to 12/31/20. Then we have our groupings that are kind of nice to see here. Now we got the receivable, and note the allowance is down here. It's not right next to the receivable because it's not in the same grouping, which you might want to do by setting it up as a receivable. But if you do so, you'll have to set up a customer for it so you can record the allowance properly there. Then we've got the depreciation. So notice here we have the equipment. It should typically be on top. The only reason it's not on top is because they're both fixed asset categories and the A starts before the E, and therefore it's in that order. Note that you could use the descending order up top by total here, and then go to descending order, and that's one way to fix it, that particular item. Or you can use account numbers, which we won't get into here. We might make a course on account numbers in a future presentation. And then we're going to go up top. We're going to go to reports up top. Let's go to the profit and loss by class now. Company and financial. Take a look at that profit and loss by class. Changing the dates up top from 01/01/20 to 12/31/20. And there's going to be our profit and loss by class. And in the unrestricted items, we see that we have our depreciation item and then we have the provision item here.